Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to sprinkle in a whole bunch of my opinions as we go through it and what we've seen in the past. May even comment and talk about Scott a little bit and some of the videos that we used to do together and our opinions and how it kind of overlays with what's going on today in the uranium market, because I know I've got one of the patterns here for uranium. So we'll go through that. Whatever I talk about is most likely going to be financial related topics, wealth building, or commodities related. Those are the three sectors that I think are very important to talk about, very important to learn about, and commodities, which I think is very good sector to be looking at this current time, given where the valuations are at and the market conditions. So let's dive in here. Let's see what's going on with the markets. We've got, again, if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. That's where I talk about individual companies, talk about the mindset, sectors. You can interact with me directly during question and answer sessions. And I tape those and put them all on the website. And I also share what I'm doing and what I'm buying in the markets. And I'll be honest, guys, we've had some really good entry points on a lot of companies. Yeah, I've blown a few. Don't always going to happen to whoever, but we've had a lot of really good ones too. And squeezing falling wedge patterns right into the corner. Boom, nice big entry points for long-term holds. So coming in here, we've got Yellow Bull. With uranium getting more widespread attention due to the powerful supply-demand fundamentals, ongoing nuclear renaissance, and relative strength, it appears we are slowly but surely entering the media attention phase of the cycle. Strap in, this will be a generational ride. So this is the main stages in a bubble. We've got the takeoff, the first sell-off, the bear trap, the media attention phase, and the enthusiasm. I know a lot of people ask me, where do I think we are in this area here? And I'm going to say, I don't even think we're in the media attention phase yet. I know that seems weird. I think we're really, really early. Why do I say that? Well, these things move up. A lot of these stocks move up together. And let me rephrase that. Some of these sectors, they got their first wave. Then we're in the second wave. Now, we could still be in the second wave. The second wave, in my opinion, for commodities would be the bear trap. We may or may not have left the bear trap yet. And the reason I say that we're that early is if you were to look at a bunch of different stocks or a bunch of different charts here, and I'll pull some up to show you guys. If you were to look at the S&P 500 versus, so we got the S&P divided by PPICO, I think. One second, producer price index. So this is the producer price index here for commodities. If we were to look at this, these were the previous commodity bull markets. It were all of these three here. And if you look at where we're at today, when this came back down, this was basically the first wave kind of the big move in commodities. I think this is going to be a double top. So if you have a double top, it's going to look something like that. And then in 1972, that's when we really came back lower. You could even state that we are like here and here in this, where we haven't even made the second top yet. So we could even be in 1968. So I would say that we're probably closer to like a 1968 and or 1970s era, which means that we're like at the beginning of the bull market, which if you were to look at something like URA divided by UX1, it puts us at the beginning of a bull market, which is I know incredibly weird. You could also state that this here is and I'm just kind of going to show you guys that this could be the breakout. So this is your double bottom kind of. This is the breakout of it, and then we did a big fat retest. And right here, like the equities have not moved that much against the physical metal, the physical commodity. And I mean, guys, we can just draw this. This is squeezing. It's squeezing right into the corner, and we're about to break this to the upside. I know a lot of people are probably wondering, what should I do? How should I enter this? We haven't even moved yet, guys. Like the valuation hasn't moved off of its bottom yet. So the median attention phase, if we were to look at this, this is kind of like wave one pullback is the wave two, wave three, and then you usually get a sideways move here, and then you rip it. You can also use CCJ as an indicator for where we're located. And um, I think that potentially the institutional investors are just starting to get positioned in this big move here. So again, this is kind of like your accumulation phase here. This is your pullback bear trap. Then you move on up. That's your third wave. So this is your first wave, your second wave. This is your third, your fourth, and then your fifth is your peak. And then you come back into a big consolidation. So um, I think that we're basically on Camco. This is just Camco. Remember, guys, just Camco. That we are just leaving the accumulation phase here, and we're just leaving that on the biggest stop. And remember, I've got and I know this might look ridiculous, guys. I'm not trying to be ridiculous, but um, I think something like this could occur. And I know, everybody thinks it's too high. I get it. But I think that's something like that could occur. So if you look at Camco, Camco is just kind of leaving its bear trap here, um, and coming out, and we're just entering new highs. So that is, according to this, entering the media attention phase for Camco. But I don't think, if you look at all the other developers, you look at all those things, they're starting to come up too, and then the explorers haven't really taken off at all. So there's still an incredible amount of opportunity given where Camco is. Camco's our leader, and it's basically taken off. You can look at Kazatomprom, and that's also another one that has taken off. And and man, this thing's a very nice looking chart. Your squeeze up, your breakout, and this is a flag pattern and or pennant formation. It's going to break to the upside again. This is one of the larger producers. This also has the chart that I look for. What this whole pattern here is a lead-in pattern. I see this pattern all the time. Basically, you get two humps here, you get a breakout, and then you get a consolidation here. And that's generally in a falling wedge in whatever. The whole commodity sector has this entire pattern. A bunch of gold and silver companies have this exact pattern. The fractal repeats over and over, given the herd creating these things, the psychological undertones of the herd is what I'll call it. But this looks fantastic to continue higher. So really, we're just coming out of those basing patterns, which we're coming out of the bear trap, which is, and this here is that falling wedge. So the first sell-off is this. That's the first sell-off. This here is your bear trap. This here is your bear trap. That's where I would repeatedly tell people we're at the beginning of this bull market. It's going to take time to materialize. And people would say, I can't handle it. I bought in 2021, which, maybe they bought somewhere in here, and then they are holding down here. They're down in their portfolio. The right thing to do is to gain the conviction in this time frame, and then to buy the corner of it. That's exactly what we did on the website. I even, made comments like, "Look, guys, we break this. I don't know. It may never come back down here again, and we might just stair step higher and continue up and up and up and up." But luckily, we still have differing size of companies, like exploration companies and etc. We are accumulating those on the website, and everyone who's part of it knows which ones I'm talking about. Some of them have just broken out of their falling wedges. And there's still a few that are still very cheap that are going to be leaving the train here at any second. So the first thing that moves is Camco and Kazatomprom. This guy, these are movers. The developers are going to move next, and they have been moving, and some of them have moved out of their patterns as well, along with CCJ. And then the explorers are going to be last. And the key here is to not blow it, to not get scared out, to gain the conviction, to be able to hold on. And the people that are able to hold on are incredibly rare. Um, Jesse Livermore, and it's the reminiscences of a stock operator. Very rare to find people who can buy it in the stealth phase and hold it all the way to the mania phase. People will sell off during this bear trap. They'll sell off because they get bored. They sell off because it's not going anywhere in a consolidation zone. They try to trade it and they mess up a trade, and then it breaks out on them and they don't get back into the stock, even though they can't buy it at a higher price. Um, this is what you need to learn. You need to learn this inside and out. You need to know where we're located. You need to know what's driving this. In my opinion, what's driving it is credit creation and inflation. It's creating money rotation out of bonds and out of potentially stocks at some point, and put a tailwind and a money rotation into uranium and energy and all these commodities. It takes time, guys. It doesn't happen overnight. You got to get your time frame right. It's got to be long enough to sustain a consolidation. Your time frame. It's got to overarch over many, 5-10 years versus a 1 or 2 year consolidation in it. And again, this I think is going to pick up speed, and we're going to see a move way up if this were to occur. And this chart here and this pattern and formation looks absolutely beautiful. It's exactly what we want to see, and we're seeing it across a whole bunch of different companies, CCJ, Camco, and etc. Coming on down, this is what I'm talking about in terms of patience. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections that has been lost in corrections themselves. So everyone's trying to time the market in the very short term for these slowdowns. Now, could we get a slowdown? Yes. How do you position for it? What strategies do you have to benefit from it? What are you doing? If you're trying to time everything, take all money out, put all money in, I think it's very difficult to time that. And with Camco breaking to the upside, with Kazatomprom breaking to the upside, with a lot of these uranium and energy companies exhibiting patterns that are the size of Montana, which means the price projections to the upside are also the size of Montana, which means huge moves could occur to the upside. There's no way I can get shaken out of these positions. If there is a slowdown, I'm not going to try to anticipate a market correction. I'm going to ride through it, be thankful that it occurred because I can add to my positions at even cheaper pricing and hold on for the bull market. That's my strategy, at least, and you guys can do whatever you want. But my strategy is to accumulate on the dips and hold the rips until the drivers of that money rotation are gone. Nat gas directed rigs fall 4 to 114, down 42 rigs or 27% year to date. What I see here is a pattern that I typically see here, and that could be a double bottom, perhaps, because what you see is you get a downtrend line in the rig count here. This is natural gas directed rig count. You get a downtrend here. That's broken the downtrend. You can also throw a trend down here. So it's a falling wedge that's broken to the upside. Then you're getting a double bottom here. That's generally a bottoming pattern in the rig count. Technical analysis works on whatever you apply it to. You can apply it to the rig count. You can apply it to whatever it is. So maybe we can see a bottoming here in rig counts. And there's ways that you can play that through and express that viewpoint in investments. So that's looking good for nat gas, even though it is down. It's looking like it's trying to put in a pattern that I've recognized before. Coming on down, the housing market feels like 2007 with low number of sales happening, but competition is not 2007 vibes. I don't know who Ryan Lundquist is, but we're not 2007 at all. 2007, we were in a hyper supply phase. We were building too many homes in 2005, 6, 7. We had inventories up around 10 months of inventory in 2007. We had forced sales, foreclosures, everything was blowing to the upside. I think that 2007 is a horrible, horrible time frame to use as a comparison. If I were to choose, we're much like 2000, 2001. We are at the beginning stages of what I think is a very big building cycle. We have low inventory. much like 2000, 2001. We just went through an increasing interest rate environment, just like 2000, 2001. The NASDAQ bubble popped. We could very much be going through a NASDAQ bubble pop at some point, like a double topping pattern or something like that, which will not, in my opinion, impact the housing market. Interest rates will fall, much like 2001, 2002. Interest rates fell and then created a big housing bubble. I think that's the same thing that's going to occur. We're going to get a big housing bubble, and maybe we're going to see a relaxation on loans, and then the big bust, like 2007 timeframe, will be the end of 2020, early 2030s. Somewhere in that range will be the bust. That's my projection there, guys. Have shown I caught the lows for 2020 for the stock market, commodities, gold, uranium, etc. Going through all that. So look at GDXJ's chart here, guys. Let's open it up. Let's take a look. So here's GDXJ. Looks like we're missing a little bit there, so I'm adding that back in because it looks like he added this here as a zoom in. What this is GDXJ weekly. This is a big downtrend line. If you were to draw it across from here, and this is a back test. We got our false breakout down here. 2016 came up, false breakout. We got a false breakout just recently in 2022, and we're starting to head higher. This is how you catch bottoms. Right here, we're looking at it right now in GDXJ. Now, if we get the right market conditions, guys, where we get a decline in interest rates, much like 2001 and 2, they declined the interest rates, they pulled back, and that's when gold took off. Then the interest rates recompressed again. So the yield curve can stay inverted. It kind of uninverts the long end of the curve. We could get mortgage rates to fall, house sales volumes kick up, and all that. The economy kicks back up, and gold, oil, copper, iron ore, it all goes up together, much like 2002 and 3. That's the bottom in the turn. So I think that's kind of where we're at today. And there could be some adjustments in the pricing in the short term for that to all occur. Like we could still go lower for a period of time before going on up, and some scares in the market perhaps. But I think that's kind of aligning that. And GDXJ looks really good right where it's located. Gary Savage says, now that the dollar is getting some downward momentum, everything is starting to scream higher just as I expected, with the exception of oil, which is going to be stuck building out the right side of the cup and handle pattern also as expected. So in 2002, 2003, after that slowdown in the NASDAQ, we saw a dollar go down. We had increasing yields, and then the yields pulled back, and then the dollar fell from that point forward. It seems very closely related to the same market conditions as that time frame. And as the dollar falls and interest rates fall, I think we could see a big move up in, well, hopefully we see a big move up in home builders and the housing starts. Housing starts are going to be credit creation, and then what we'll see is most likely a move higher in interest rates after that inflation gets going again. But right now, home sales volume is way down. Housing starts have pulled on back, just like 2001, 2002, and then we're gonna watch yields and see how the housing market interacts with it. And why I talk about the housing market so much is that's the credit expansion driver, at least historically, which has pushed commodity prices higher. We could be doing that with fiscal spending and deficit spending in the short term here, and maybe we don't need the real estate market to kick in. But I like to watch the real estate market because that's a function of the economy and the health and credit expansion in the system. Temporary help requirement is collapsing. This occurs near sharp economic downturns, is what he's saying. This downturn, here's 01, and then we could see we bottomed in 02, 03, and then we started coming back on up. I think we could turn this corner and move on up depending on how strong interest rates fall and how strong the housing market reacts to it. And that's where this gets really funky. We also have basically stimulative measures coming from deficit spending, which makes it even more complicated. And the deficit spending could be stimulative enough where it kind of carries the market on a nominal term basis. Why there won't be a housing market crash in one headline. The share of Americans who are mortgage free is at an all-time high. Almost 40% of US homeowners own their homes outright as of 2022, many of them baby boomers who refinanced when rates were low. People say nat gas may have already hit its highest this winter in early November when it closed at $3.52 on November 3rd. It is not unusual for the highest price of winter to occur in November because the anticipation of cold is usually worse than the actual weather. And that may very well could be the case, but that's why I'm sharing it. Could be the case. Scrolling down, Goldman looking for a range-bound Brent of 80 to 100 a barrel for 2024. OPEC put. U.S. supply growth slowing and robust global demand. Stress testing that range as well. Note published today, just as Brent price gets clipped. So their expectations is $80 to $100 a barrel. That could be the case for 2024, and the big move might occur after 2024 because the slowdown in the system in terms of inflation and credit creation has occurred. And we could be slow for 2024, and then it might pick up later 2024 into 2025, 2026, where we get a big move in credit expansion. But again, we'll have to wait and see. If home builders continue to go up and the housing starts continue to go up, those two, then there's a lag effect between the credit that's being created and the inflation from that credit being created in the system. The lag is generally 12, 18, 24 months, somewhere in that range. So 12 to 24 months is the lag. And that lag is going to be slow. The slowdown in inflation and that lag is going to come 2024. And then in 25, 26, we could see another resurgence of inflation. We're at a point at which we're borrowing money to pay debt service. We're at the point of that acceleration, which creates the supply-demand problem in terms of bonds. So another article there, and Ray Dalio's opinion. The number of Airbnbs in Oklahoma has increased from 400 to 2,400 in recent years. So this person thinks there's some Airbnb. And then Logan says, less than 1% of total housing units in America, a Sith Lord even knows this. So Airbnbs are such a tiny percentage of the housing supply problem. It is less than 1%. So all these people talking about an Airbnb problem, where all these Airbnbs are going to come, oh my God, it's going to kill it. It's less than 1% of the total housing units in America. And also keep in mind that we have large deficits of housing. So the Airbnb, if 10% of Airbnb goes bust and it's 10% of 1%, it means it's 0.01% of the units in America. And that's not even going to cover the deficits that we have today of the people wanting to buy homes. Stocks typically bottom after the unemployment rate rises significantly. But currently, stocks are rallying like the economy is in perfect condition. Is this time different? I would say this time is different. Why? Because I think that the interest rates went to a level that was unsustainable, but the underlying market economy is still strong with the housing market, and that's where a lot of the jobs come from. It comes from construction. It comes from all those things. So I can type in and look at some of the construction jobs numbers, and they are very strong. So if we were to look at those really quick, this is total construction spending in America, and you can see that we are moving higher. We've already went through the slowdown here, and we are moving on up. Now, how sustainable is that? I don't know. We'll have to wait and see. U.S. construction, all employees continue to moving on up. That latest data was October of 23. So that's continuing to move up. Last time we saw a decline in 07 where it really came back lower, but we went sideways in 2006, and then it declined in 07, and then we had the crash in 08. So that's what occurred there in the last market. We're still continuing higher in this metric. Total construction spending is continuing to move up. We had a little bit of a slowdown in 2022, but that's rocketing back up. Last time that occurred, we rolled over in 05, 06, and then we rolled over again in 07. So this was a topping pattern, and then it collapsed. We don't have that topping pattern yet. We're just continuing to stair step higher and higher in total construction spending. So there's some data there that goes against this and saying that maybe this time is a little bit different. I think if they were to lower rates, that we would see the home builders take off and housing starts take off to the upside, and we would reignite inflation. And I think Powell thinks the same thing. That's why he says higher for longer. This is an important day to highlight the following. 71% of investment advisors hold 0 to 1% of gold in their portfolios today. I cannot recall a time in history when the metal was so underallocated as it is currently. So what he's trying to describe is no one's in this stuff. We are that early. No one owns it. This is the history on it. Here is 2017, 18, 19, 20, 21, 22, and 23. This is asset allocated to gold among all book of business. No one owns more than 10% of or more of gold. There's 2% that own between 5 and 10%. 27% own between 1 and 5%, and 71% own basically nothing. So if you want to know the money flows, no money is sitting over in gold in relationship to history and or today. Just no one owns it. It's under owned. If this starts to outperform, I guarantee these people are going to FOMO in. It just takes time. So the institutional investors, they're not in it. Hardly anybody's in this, guys. Peter Sutherland says, for all the Strum and for all the Sturm and Drang in oil lately, Brent is still $80. Refinery maintenance is tapering without large inventory builds. Distillate stocks and scant and seasonality will soon be a tailwind. The recent swoon is not fundamental and should be taken seriously, but not literally. That's his opinion there. North Star is talking about uranium, the roadmap laid out 3 years ago at the breakout and continues to follow through. We've got some resistance here that we're working our way through, and we're going to go much higher, in his opinion, for the global uranium ETF. And we could get all the way back to its all-time highs later on, maybe later 2020s. And I agree with that. It also overlays the housing starts and the inflation that would be driven by the housing starts. Late 2020s is where my projections are. Always know the very big picture. The big breakout level for silver using the yearly time frame is $31, $32, not 38 or 50. That is on the lower time frames. The blue tightening arrow pattern means a breakout is coming. A 43-year very bullish pattern. Let that sink in. This is a big cup and handle, and the price projection is $248 is the measured move from $31 using the yearly candlesticks. It is mind-boggling that Apple and Microsoft's weight alone in the S&P 500 is 70 times larger than the entire metals and mining industry. Two companies and their weights is 70 times larger than the entire metals and mining industry. That is ridiculous. Metals and mining, 0.2, and this is Apple and Microsoft. 70x bigger than that. This is the whole energy sector, which is much larger. Apple and Microsoft is bigger than the entire energy sector. That just seems weird to me. And this is energy, real estate, utilities, and materials combined. Apple and Microsoft is bigger than all of it combined. Very big picture, there's a massive divergence between gold and silver. Last time the two had a larger divergence like this, silver played catch up big time. And this time silver will break out of a 43 plus year cup and handle pattern. So the overshoot this time should be absolutely mega. So silver is going to be a potentially good outperformer versus gold. I think platinum will be as well. All these will. Here's another one. Those who say that the drop in the price of oil is due to a future recession should be able to explain the rise in the price of iron on this same thesis. And here's your breakout there. You can come through here. It's basically a wedge pattern that's broken to the upside. And we're breaking and moving for iron ore. Yearly change, 36%. And that's what we've got for today, guys. That's where I'm going to end it. So hopefully you guys are doing good today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We do have a larger discount coming up for Black Friday. I'll release that at some point this next week. Look for it. It's going to be very similar to the same discount as the Halloween discount. So look for that coming on up. We have a platinum question and answer session coming up at 5 p.m. on Sunday. You can ask me whatever questions you guys want. We'll go over a lot of portfolio and positioning, looking at specific companies, looking at sectors that we normally do. And I'm going to probably talk about some lead-in thing with it to get you guys a little bit more confidence in the bull market and where we're at. All right, guys, that's what I've got for today. We'll catch you later. Finding value.